Tips to avoid overborrowing for investment immigration. Thinking of securing a second residency or citizenship through investment immigration. It's a great move, but it comes with big financial decisions. One of the biggest pitfalls is overborrowing. In today's video, I'll share smart, practical tips to help you avoid falling into unnecessary debt while pursuing your global dreams. Why this video matters. Investment immigration programs offer exciting opportunities to better healthcare, education, visa-free travel, or business expansion. But they often come with hefty price tags ranging from $100,000 to over $2 million, depending on the country and the type of program. And here is the problem: many people fund these investments through excessive borrowing. That's a dangerous path. It can strain your finances, reduce your chances of long-term success, and even disqualify your application. This video is your guide to staying financially smart. Let's dive into real strategies that can keep your dream alive without burying you in debt. Tip 1. Understand the true cost of immigration. Most people only focus on the minimum investment number advertised. But that's just the beginning. You also need to consider government fees, which can run into tens of thousands of dollars, legal and processing fees, due diligence and background check costs, translation and documentation costs, relocation and resettlement expenses, currency exchange losses, or international wire fees. So before you think of borrowing a dime, calculate the total cost. This gives you a realistic idea of the actual investment needed, not just the headline number. Tip 2. Avoid funding your investment entirely with debt. One of the worst mistakes is taking on debt to cover 100% of your investment immigration cost. Why? You'll have monthly repayment obligations, possibly in a foreign currency. If your income doesn't stabilize quickly in the new country, you'll struggle. You could risk foreclosure or bankruptcy if it's tied to your property or business. Instead, aim to fund at least 70% of your investment from your own savings or liquid assets. Borrowing should be limited, short-term, and well-planned. Tip 3. Choose the right immigration program for your budget. Not all investment immigration programs are created equal. Some are affordable, while others are luxurious and high-risk. If you're on a limited budget, consider these cost-effective options. Dominica Citizenship by Investment starts at $100,000 donation. St. Lucia or Antigua and Barbuda lower costs and family-friendly. Portugal D7 or Startup Visa if you can prove regular income or entrepreneurship. Greece or Latvia Residency by Property Investment. Avoid jumping into a $1 million US at -5 investment just because you saw an ad. Find a program that fits your current wealth level, not your ideal future earnings. Tip 4. Build a financial plan, not just an immigration plan. Immigration isn't just about paperwork. It's a complete lifestyle and financial transformation. Before you even apply, create a budget for the full journey. Application, relocation, setup, and first year abroad. Build an emergency fund with at least 6 months of living expenses. Forecast your income in the new country. Will you earn immediately, or will it take months? Speak with a financial advisor about your liabilities and cash flow. This financial plan helps you see whether borrowing makes sense here, if it will cause more harm than good. Tip 5. Explore alternative funding options. Instead of traditional loans, consider smarter, lower-risk ways to fund your immigration. Liquidate underperforming assets. Maybe it's time to sell off a second car, an unused plot of land, or old investment portfolios. Use profits from a business or side hustle. Many people save for immigration by setting aside a portion of their income over time. Joint family funding. Some families pool resources for one member to migrate and later bring others through family reunification. Angel investors for entrepreneur visas. If you're applying through a startup route, consider raising funds from angel investors rather than taking loans. Be creative, but cautious. The goal is to minimize financial risk. Tip 6. Only borrow from trusted, transparent lenders. If you must borrow, do it right. Choose banks or institutions that are experienced in international lending. Avoid private or offshore lenders, offering fast approval or no documentation any are predatory. Carefully review interest rates, currency exchange risks, and repayment terms. Calculate your debt-to-income ratio and ensure you'll still have enough cash flow after repayment. Pro tip: ask your immigration advisor if the source of your loan is acceptable under the program's due diligence requirements. Some countries frown on large loans or unverified funds. Tip 7. Beware of emotional decisions. Investment immigration is an emotional journey. You're chasing a dream of a better life. But don't let that emotion drive your finances. Avoid making snap decisions based on peer pressure or online success stories, rushing to beat the deadline before fully understanding the financial implications. Overestimating your ability to repay, especially if your future income isn't guaranteed. Take a step back, sleep on it, talk to a mentor, financial planner, or family. Then proceed. Tip 8. Work with verified experts. One of the smartest moves is to hire experienced, verified professionals, licensed immigration consultants who understand the financial requirements, accountants, or financial advisors who can run your numbers realistically, reputable law firms that explain every cost, step, and financial risk. They'll help you avoid scams, overpaying, and borrowing more than you need. Tip 9. Plan long-term not just to get the visa. Getting your residency or passport is just the start. You'll still need to pay taxes in the new country, maintain a property or business, possibly meet physical presence or renewal requirements, fund your children's education or a new home. If you overborrow just to qualify for the visa, you may struggle to sustain your life afterward. That's why long-term financial planning is non-negotiable. Tip 10. Know when to wait. Here is a hard truth. Sometimes it's better to wait 6 months or a year than to borrow recklessly today. Use that time to save more, strengthen your credit, build a side income, reduce your existing debt, learn more about your target country. There's no shame in waiting. In fact, it often leads to better financial security and smarter decisions down the line. Recap: smart choices, lasting freedom. Let's quickly recap the top tips to avoid overborrowing for investment immigration. Know the full cost, not just the advertised fee. Don't fund your immigration entirely with debt. Choose a program that fits your budget. Build a financial plan from day one. Consider alternative sources of funding. Only borrow from trustworthy lenders. Avoid emotional financial decisions. Work with certified immigration and financial experts. Plan for long-term life in your new country. Don't rush it if needed and grow your resources first. Smart money decisions lead to freedom, not just a passport. Remember, immigration is a life-changing journey, but it should not come at the cost of your financial health. You can pursue your global dreams wisely without burying yourself in debt. If this video helped you, give it a thumbs up, subscribe for more smart immigration tips, and share it with someone who's planning their move abroad. Got questions? Drop them in the comments, and I'll answer every one.